A Man for All Markets, From Las Vegas to Wall Street, How I Beat the Dealer and the Market by Edward Thorp. This book is the autobiography of Edward Thorp. Thorp is a mathematician, but he is best known for his achievements in gambling and investing. He is a legendary figure who conquered the casinos of Las Vegas and is considered a pioneer of quantitative investing, reshaping the securities investment industry. Whether in a casino or the stock market, the prevailing belief is that you cannot beat the house or the market. Note that outperforming the market is not the same as winning the market. Good performance might be due to luck. You can only claim to have beaten the market when you find a statistically significant edge and consistently profit. If your investment performance is good, it's likely good luck, not necessarily winning the market. However, the subject of this book, which is also its author, Edward Thorp, believes that gambling and investing can be simplified into scientific problems, more specifically, mathematical problems. He used mathematical methods to prove that players can beat the house and investors can beat the market. After proving this theoretically, he verified it through practical experience. He made a fortune in the casinos of Las Vegas first, then he published his methods, leading countless gamblers to flock to Las Vegas, forcing casinos to change their rules. Subsequently, he successfully managed a hedge fund, achieving investment returns comparable to Warren Buffett's, with the notable distinction of never having a losing year in his 29-year career, a feat even Buffett did not accomplish. For these reasons, Thorp dares to call himself a man for all markets. The thought models and methods he developed apply to gambling and investing and are helpful in other areas of life. In this audio summary, I will explore Thorp's thought models through 3 questions. 1. How did Thorp manage to beat the casinos? 2. How did he beat the market? 3. How did he manage risk? Part 1. How Thorp beat the casinos. Many scientists focus on theoretical research and pay less attention to its application. Thorp was different. He studied theory but was more interested in using it to solve practical problems. Thorp was brilliant from a young age, particularly interested in conducting various chemical experiments, and even made explosives for fun as a teenager. Coming from a low-income family, he self-taught himself in a few months to win first place in a national physics competition, securing a college scholarship. He completed his undergraduate and master's degrees in physics and then pursued a PhD in physics. While working on his dissertation, he needed to use a lot of mathematical knowledge, and his interest shifted to mathematics, leading him to earn a PhD in mathematics and eventually become a mathematics professor. In addition to teaching, Thorp was passionate about researching practical mathematical problems, especially those related to probability and gambling. During high school, he heard the saying that players cannot beat the house because, from a probabilistic standpoint, the house always wins in the long run. All gambling games are designed so that the house's chance of winning is slightly greater than 50%, enough to guarantee that it will eventually take the player's money if they keep playing. Many famous mathematicians in history have studied the probabilities of gambling games, but before Thorp, their conclusions generally agreed that it was impossible to beat the house. However, Thorp had a characteristic that others' words didn't hold much weight for him. He needed to test them himself to believe them. After examining various gambling games, Thorp found that the game with the smallest house edge, the most player-friendly game, was blackjack, also known as 21. Even so, the house still had a slightly higher chance of winning. The rules of blackjack are simple. Each player initially receives 2 cards and then decides whether to take more. The goal is to get the sum of the cards as close to 21 as possible without exceeding 21. Going over means a bust, resulting in a loss. Thorp's research into this game revealed that the player's winning probability isn't fixed, but changes with the cards dealt. As cards are dealt from a deck, if many low-value cards come out first, the remaining deck has a higher proportion of high-value cards, which is advantageous for the player. This is because players can stop taking cards at any time, while the dealer must continue drawing cards if their total is below 17. The higher the cards left, the more likely the dealer will bust, increasing the player's chances of winning. In 1959, Thorp used the limited computing power of IBM's early mainframe computers to simulate all possible scenarios and probability distributions. He discovered that the player's winning probability could exceed the dealer's by up to 5% under optimal conditions. Theoretically, if players only bet when the odds are in their favor, they can beat the dealer. However, going into practice requires more than just theoretical probability. Casinos don't allow computers or delay tactics. Players must quickly calculate odds in their heads. Thorp further simplified the problem and developed an easy-to-use card counting method called the high-low method. Here's a brief overview. Low cards, 2, 3, 4, 5, 6, are counted as +1, medium cards, 7, 8, 9, as 0, and high cards, 10, J, Q, K, A, as -1. The higher the total count, the more favorable the remaining cards are for the player. After developing his winning strategy, Thorp tested it at Las Vegas casinos, proving its effectiveness. He then published a paper, attracting media attention. At that time, most people did not believe there was a way to beat the house, the media were skeptical, and casinos ridiculed Thorp as just a bookworm. But the casinos soon stopped laughing. Thorp tipped $10,000 to Las Vegas and doubled his money in 30 hours. It was a significant sum at the time, drawing the attention of the casinos. They started using various tactics to hinder him, such as increasing the frequency of shuffling, changing decks, refusing to sell him large chips, and even using cheating dealers. Despite these challenges, Thorp continued to win. Finally, casinos resorted to their last option, banning the consistent winner. Thorp ended up on the block list of several casinos. The casino's troubles had only just begun. Thorp then wrote a book revealing his blackjack strategy, Beat the Dealer. Published in 1962, it quickly became a bestseller.
Thousands of card counters flocked to Las Vegas using Thorp's methods, shaking the very foundation of the casinos. The casino bosses met, and while some suggested taking drastic measures against Thorp, they ultimately chose a more civilized approach. Changing the game rules to regain the probabilistic edge, Thorp continued to visit casinos in disguise, but his consistent wins always drew the casino's attention. He recounted two harrowing experiences in his book. Once, after a series of wins, he felt poisoned after drinking casino-provided refreshments. Another time, while driving down a hill at over 100 miles per hour, his brakes failed, almost causing a severe accident. Winning money was great, but risking his life wasn't worth it. Thorp, still a mathematics professor with teaching and research duties, decided to give up gambling. Besides, his strategy had been thoroughly validated, leaving him satisfied. In addition to blackjack, Thorp used mathematical methods to study other gambling games, like roulette. Roulette involves predicting where a small ball will land on a spinning wheel.
Roulette is a pure game of chance, with the house holding an absolute probabilistic advantage. But Thorp believed that the ball's descent and final stopping point were physical problems. By recording the ball's trajectory and speed, one could predict its landing area. Thorp and his colleague, Claude Shannon, the father of information theory, developed the world's first wearable computer. This computer, the size of a cigarette pack, was hidden in a shoe with the controls. The computer calculated the roulette ball's trajectory and provided a predicted result. They tested it in casinos and proved it effective, but they eventually shelved the device due to the immature technology and frequent malfunctions. Part 2: Conquering the Financial Market. After defeating the casino, Thorp's interest shifted towards the financial markets. There's a saying that the stock market is just a casino, which might not be entirely accurate, but there are undeniable similarities between investing and gambling. Both rely on mathematics and probability analysis, both require balancing risk and reward, managing positions, and maintaining a high level of rationality. In some ways, gambling is a simplified version of investing. If it's possible to win in the casino through mathematics, can a mathematician also succeed on Wall Street, the world's largest gambling market? Thorp's initial experience with financial investment could have been more pleasant. While continuing his teaching job, he invested his casino winnings and book earnings in the stock market. Like many retail investors, he chose stocks based on newspaper tips and expert advice, and like many, he quickly lost half of his money. Determined to succeed, Thorp reconsidered his approach. How could he invest successfully and achieve statistically significant outperformance? Economists often refer to the efficient market hypothesis, EMH, which suggests that the market fully reflects all known information and stock prices immediately incorporate any new information. According to EMH, any investment advantage is limited, short-lived, and generally unachievable. Aside from a few lucky individuals, investors cannot consistently outperform the market average. High returns always come with high risks. But Thorp was not one to take conventional wisdom at face value. He turned to mathematics once more. Thorp's approach was to simplify investing into a pure mathematical problem. Instead of selecting individual stocks, he focused on hedging. Hedging involves taking one investment to offset and reduce the risk of another. For example, a funeral home selling medicine would profit whether people lived or died, which is a form of hedging. In financial investing, risk hedging means using one investment to mitigate the risk of another, typically choosing investments with high correlations. For instance, comparing General Motors to Coca-Cola might not be practical if you choose stocks due to their different risk factors. However, comparing Coca-Cola to Pepsi, which faces similar external risks, allows you to buy the better and short the worse, effectively hedging against most external risks. Thorp's strategy took this hedging concept to the extreme, eliminating the need to pick companies. He focused on different securities issued by the same company, which would move similarly but have price discrepancies. He'd buy the cheaper and short the more expensive one, profiting as the market corrected the pricing error. For example, he made significant profits trading different AT&T securities during its split into a new AT&T and 7 Baby Bells. The market favored the new company, making the old stock cheaper. Thorp bought the old AT&T stock and shorted the latest stocks, earning $1.6 million as the market corrected the prices. This strategy is known as market neutral because it doesn't depend on market direction. Indeed, Thorp never had a losing year in 29 years, with an annual compounded return rivaling Warren Buffett's, including during major market crashes. The key challenge is knowing the pricing of these securities to identify opportunities. Thorp did this with options, contracts giving the right to buy or sell fixed-price assets. He used mathematics to determine the fair value of these options, finding many markets mispricing to exploit pioneering quantitative investing. His book Beat the Market became a foundational text for quantitative investing. Thorp founded the world's first quantitative hedge fund, mimicking Buffett's model. Today, quantitative investing is a significant approach globally. Thorp's pioneering work fundamentally changed the securities investment industry. Later, Thorp refined his options pricing model but kept it private, using it to earn quietly. Another group of mathematicians, inspired by Thorp's work, published a similar model and won the Nobel Prize in economics. Thorp, missing out on the Nobel, had no regrets, understanding the trade-offs of his choices. From 1969 to 1988, Thorp's funds returned 27x and 15x, respectively, with annual average returns of 18.8% and 15.1%, compared to the S&P 500's 10.2% during the same period. Despite major crises, Thorp's funds never had a losing quarter, proving his ability to beat the market. Part 3: Risk Management. In the final chapters of the book, Thorp offers many pieces of advice for ordinary investors, the most important of which is his approach to risk management. Thorp had an extreme aversion to risk. Although he gambled in Las Vegas and later managed large sums of money on Wall Street, often dealing in the billions, his strategies were always based on rational analysis with low risk. For him, gambling and investing were not games of chance, but scientific experiments. As a mathematician, Thorp's advantage was in theoretically deriving optimal strategies. However, there is a gap between theory and practice, namely the uncertainty of reality. Even with a low probability of loss, the consequences of losing could be severe. In the early 1960s, Thorp invested in silver. Following a bank's advice, he anticipated a significant rise in silver prices and borrowed money to buy silver. Initially, his prediction was correct, and silver prices rose, earning him substantial profits. However, these profits were not realized, and a subsequent short-term drop in silver prices, amounting to 1/3, resulted in losses exceeding his principal due to leverage, causing him to lose the entire investment. This incident made risk management a primary focus for Thorp throughout his 50-year career. Even with the proper judgment, Thorp lost his money. The issue lies in position management, the core of risk management. If you bet too small, the gains are insignificant. If you bet too big, you risk a complete loss. Once you lose everything, you cannot recover even with a sure win opportunity. Is there an optimal betting strategy that maximizes returns without excessive risk? Yes, there is. While refining the blackjack strategy with Professor Shannon, Thorp learned about the Kelly formula. Discovered by physicist John Kelly, the Kelly formula dictates how much to bet. Betting ratio equals winning probability/odds. The winning probability is the advantage over the house, and the odds are the expected return per unit bet. By calculating these, you can determine the proportion of your current funds to bet. Thorp applied this in Las Vegas, starting with $10,000. He bet the minimum when the odds were against him and increased his bet to a maximum of $500, 5% of the total, when the odds were favorable. Unlike most gamblers who increase bets on winning streaks and try to recover losses, Thorp relied solely on mathematics, consistently using the Kelly formula, which ensured his consistent winnings. Mathematically, the Kelly formula provides two significant benefits: the highest long-term compounded growth rate and protection against losing the entire principal. Despite the Kelly formula's importance, Thorp did not explicitly include it in his book's text, likely because the underlying mindset is more crucial than the formula itself. In real life, probabilities and odds are not as clear-cut as in gambling, but the Kelly formula's principles can improve decision-making. 1. Bet according to the winning probability and odds. Higher probability and lower risk warrant larger bets. 2. Only bet everything if the winning probability is 100%. Thorp applied this formula to subsequent gambling and investing, popularizing it in the financial world. Notable investors like Warren Buffett, Charlie Munger, and Bill Gross have acknowledged using the Kelly formula in risk management. Charlie Munger once said, "When the world gives you an opportunity, the smart investor bets heavily when the odds are overwhelmingly in their favor. The rest of the time, they do nothing but wait." It encapsulates the essence of the Kelly formula. However, only some people on Wall Street understand the importance of risk management, as evidenced by numerous high-risk, high-reward cases that ended in disaster. Long-term capital management, LTCM, is a classic example. LTCM, once a Wall Street dream team, included Nobel laureates who discovered the options pricing model. They even approached Thorp for participation or investment, which he declined, believing their leaders favored high risk and lacked practical experience, potentially making them armchair theorists. Founded in 1994, LTCM initially boasted annual returns exceeding 30%, built on high leverage and risk. Their leverage ratio varied from 30 to 100 times, magnifying small profits but risking total loss with a 3% market drop. Despite estimating a minuscule probability of loss, this low-probability event occurred in 1998, resulting in a $4.6 billion loss and collapse. Thorp remarked, "They bet too much, leading to disaster." Perfect application of the Kelly formula requires precise probability estimates, which are feasible in casinos but challenging in real-life investments where investors tend to be overly optimistic or pessimistic. Thorp recommended a more conservative approach to mitigate this, betting even less than the Kelly formula suggests. Thorp warned against projects claiming 100% returns with high yields, urging skepticism. In 1991, Thorp exposed such a scam. Asked to review an investment company's portfolio, he found a fund suspiciously achieving over 20% annual returns for 10 years with no losses. Thorp investigated further and determined that the strategy couldn't consistently yield such results. Comparing the fund manager's trades to actual market transactions, he found many were fabricated. Following Thorp's advice, the company withdrew its money. Despite continued regulatory neglect, this scam persisted until the 2008 financial crisis exposed Bernard Madoff's $60 billion Ponzi scheme, affecting 4,800 clients, including many prominent figures.